There is a persistent myth that professional investing is exactly like the movies. You call up your advisor, ask what single stock is hot today, make a trade, and wait to get rich. In reality, providing isolated product advice without understanding a broader financial context violates a professional's core responsibilities. Financial advisors operate under a fiduciary duty, meaning they are legally bound to act in their client's best interest at all times. This diagram shows the regulatory approach to client categorization across the industry. Notice the dual opposing arrows demonstrating an inverse relationship. Clients with the least knowledge and experience are legally required to receive the highest levels of protection. To provide that protection and eliminate uncertainty, proper wealth management relies on a rigorous, continuous cycle. This chart outlines the financial planning process in 6 specific steps. Look closely at where the actual purchasing of investments happens. Implementation doesn't occur until step 5. Before a single dollar is put into the market, the advisor has to overcome a massive data deficit. They have to map out the exact shape of the client's life. This mapping process is known as KYC, or Know Your Client. It starts by establishing a purely objective baseline. Age is the primary anchor. A client's specific age dictates their overarching time horizon for investing, which strictly caps their capacity to take on capital risk. A 30-year-old has decades to recover from a market crash. An 80-year-old does not. The advisor then needs precise details like tax IDs, domicile, and residency statuses. These are mandatory to determine eligibility for specific tax wrappers, specialized accounts designed to legally shelter investment gains from taxes. From there, the advisor conducts a comprehensive audit of all current assets, outstanding liabilities, and existing pension arrangements. You can't build a reliable route to a destination until you find the exact starting line. Even with those numbers in place, standard practice dictates a strict liquidity safeguard. Advisors generally require clients to hold 6 months of living expenses in a liquid reserve. This prevents the client from having to suddenly sell off parts of their portfolio during short-term market volatility. This hard data clearly outlines the mathematical boundaries of a portfolio, but demographic math alone does not reveal what the client actually needs the money to do. To figure that out, the advisor transitions to the soft facts. These are the deeply personal, physical, and psychological variables that directly alter asset allocation. Take physical health, for example. If a client is in poor health, the strategy immediately shifts away from long-term equities and toward producing immediate, reliable fixed income generation to cover care costs. Conversely, a family history of longevity demands the complete opposite approach. That client needs aggressive, long-term equity growth to ensure they don't eventually outlive their capital. The advisor also conducts interviews to uncover psychological beliefs about money. They assess the client's true risk tolerance, how they react to seeing a portfolio drop in value, and unpack any past financial traumas that might cause them to panic and sell at the wrong time. Then come the complex family dynamics. The advisor factors in the cost of providing for dependents, funding future education, or anticipating major estate planning transfers. These subjective soft facts are the true engines of the strategy. They dictate the ultimate behavior and purpose of the portfolio. Here is where we hit the inevitable point of friction. Clients often possess infinite financial desires, like wanting high returns with total safety, but they have finite resources. There is a massive tension between what a client wants to achieve, the assets they currently possess, and the market volatility they can actually endure. The overlapping center of those 3 variables is the only viable strategy zone. The advisor has to manage this tension through a strict prioritization process. They force the client to distinguish between mathematically essential needs, like basic retirement income, and desirable wants, like a vacation home. This chart details both objective and subjective factors. Looking specifically at the objective factors row, you can see how timescale, wealth, and stage of life act as strict constraints on risk. The portfolio can only take on as much risk as these life factors allow, regardless of how aggressively the client wants to grow their wealth. A functional, legally sound investment strategy is only born after completing this rigorous mathematical reality check. All of this data synthesis, the hard demographics, combined with the soft human reality, is finally translated into step 4,
the action plan. Abstract human goals are converted into concrete mechanics. The advisor sets specific asset allocation percentages and builds the exact tax planning structures required to meet the client's prioritized targets. But the process doesn't end with implementation. Notice the yellow segment on our chart labeled O6 Review. Life isn't static. Markets crash, health fails, businesses sell, and inheritances arrive. Because life changes, the strategy continuously loops back through this cycle. A professional investment strategy operates as a continuous financial mirror, evolving in tandem with the client's own life.